Your stock to bond ratio is the single biggest driver of your long term wealth. Many investors default to a 60/40 portfolio, which is 60% stocks and 40% bonds. This is what a lot of target date funds are invested in and what many advisors suggest. But history shows over a 20-year stretch, an 80% stock and 20% bond investment portfolio can nearly double the growth of a 60/40 investment portfolio. Hi, I'm Erin of Truly Aligned.
And I'm Maximilian of Truly Aligned. We own a wealth management firm serving hundreds of clients and managing millions of dollars in assets. Stocks are like a gas pedal. They drive the long-term growth of your investment portfolio. Bonds are like brakes. They keep things steady, but if you overuse them, they can really slow you down. In general, stocks build wealth, bonds provide stability. Holding too many bonds too early in your career or for goals that are many years away really slows down your growth of your investments, especially for money that you won't access for 10 plus years from now. Why this is important? The single biggest risk you face in retirement is running out of money. And that's why investing in stocks is so important. They give you more growth to help combat inflation and combat the cost of goods and services becoming more expensive as you age. So stocks really are that gas pedal that helps you cruise through retirement. In our last video, we talked about the importance of diversification when it comes to different types of investment vehicles and how they're taxed. Now we're going to break down how to build out the diversification within that investment portfolio. A smart investment portfolio isn't just about investing between stocks and bonds. It's about creating true diversification, which comes from investing not only in the United States, but internationally in between different sectors and different sizes of companies. We recommend this so that your future is not dependent on one sector or one country doing well, that you're truly properly diversified.
One of the biggest mistakes we see from investors who self-manage is that they have their portfolio in 100% of the S&P 500. Now, the S&P 500 has done well over the past decade, but when we're talking about true diversification, here's how it can break down. Number one are large cap stocks. These are large companies, think Apple, Microsoft, and Johnson & Johnson. These are the steady players and they form the backbone of the US market, or what I was mentioning, the S&P 500. Now, to diversify even further, you want to include mid-cap stocks. These are medium-sized companies. They're not global giants yet, but they are growing fast and they can deliver more growth, but they do come with a little bit more volatility than those large companies do. And if you don't know, volatility is the changes that happen within the stock price. You also want to include small cap stocks. These are younger, smaller companies. They have a high growth potential, but they do have a lot more volatility and they haven't been tested in any tough markets yet. And the last way you can diversify in your stocks is with international stocks. These are companies that are based outside of the United States. In Europe, Asia, emerging markets, these can add global balance and growth potential, especially when the US market slows.
Now, the analogy that we love when it comes to diversification is think about diversification as a sports team. For your large cap, these are your reliable veterans that have been tested time and time again. Your mid cap companies are your rising stars. They have the potential to become the next Apple, though there's still a little unknown there. Your small cap stocks are your highly energized rookies. They've not been as tested as much yet, though they have the ability to potentially become the next Apple as well. International stocks are like trading for players overseas. It gives you a lot more variety and diversification on your sports team. So when it comes to building out a successful sport team, it's similar to a successful portfolio, is that we don't want to just focus on one thing. We want to be broadly diversified. And for the United States, over the past 30 years, it's been the best place overall to invest in contrast to Japan, China, European Union, Australia, etc. And for that reason, we weight more of our portfolio to be invested in US companies. For the majority of our clients, we have roughly about 70 to 80% of their portfolio invested in companies in the United States. So much of what drives a stock price going up is earnings and innovation. And currently, the United States is still the center of innovation throughout the world. China's catching up, though for 60% of companies that are in China, they're partially owned by the government, so they don't have the same incentives to increase their stock price. So for those reasons, that's why we still favor investing in the United States overall versus the majority of other investment markets.
If you have a 401k, it's very likely that you are invested in a target date fund. These are the most common investments that you are automatically put into when you open your 401k. The way that a target date fund works is it estimates when you're going to retire and then it automatically adjusts the portfolio as you get closer to that age, adjusting the stock to bond ratio. The problem that we see with target date funds is that they often start adjusting a lot earlier than they should, and they start putting bonds into your portfolio at a younger age than us experienced professionals would ever recommend. This is cutting your growth off way too early, and especially during the years when your money could be compounding at its highest growth rate for you. When they start selling your stocks and turning them into bonds 10 to 15 years before you're going to even be using the money, it can feel safe. However, it does leave your investment portfolio underperforming, and your retirement savings could be lagging behind what's possible for you. And that's why we recommend going into your 401k and creating a custom allocation. This allocation should be designed around your goals, your timeline, and your risk comfort. By creating a custom allocation like this, you can stay invested in growth assets for a longer amount of time while still balancing the volatility.
You don't need to settle for a one size fits all investment strategy. If you want to maximize your potential returns of your investments, book a call with us. We're here to help.
Until the next time, stay aligned.
Stay aligned.